Why does my adjustable mortgage rate change with the SOFR index? Imagine your mortgage rate as a roller coaster that goes up and down based on the financial tracks it follows. That's what happens with an adjustable rate mortgage tied to the Secured Overnight Financing Rate, or SOFR for short. SOFR is a daily rate that shows how much banks pay to borrow money overnight, backed by U.S. Treasury securities. It's like a snapshot of short-term borrowing costs in the financial world. When banks borrow money, they look at rates like SOFR to decide how much to charge for loans, including home loans. If SOFR goes up, it means banks are paying more to borrow, so they pass those costs onto you by raising your mortgage rate. When SOFR drops, banks pay less to borrow, and your mortgage interest rate can decrease too. Your adjustable rate mortgage has a fixed margin added to the SOFR rate. For example, if the SOFR is 5% and your margin is 2%, your total rate would be 7%. This margin stays the same throughout the loan, but the SOFR index changes regularly. The rate adjustments happen at intervals specified in your loan agreement, like every 6 months or once a year. To smooth out daily fluctuations, the SOFR used for calculations is often a 30-day or 60-day average. This helps prevent your rate from changing too wildly from day to day. Using SOFR as the benchmark is part of a broader move away from LIBOR, which was used before but is no longer reliable. Banks and credit unions prefer SOFR because it is transparent, market-based, and reflects real borrowing costs. For you as a borrower, this means your monthly payments can go up or down over time, depending on how the SOFR index moves. It can be a good thing if rates fall, but it also means your payments aren't fixed for the life of the loan. Overall, your adjustable mortgage rate changes with the SOFR index because it mirrors the actual costs banks face when borrowing money. As those costs shift, your loan's interest rate adjusts to stay aligned with current market conditions.